Hello everyone, Mehdi for Tokyo Alpha Mine. I'm a finance and AI professional as well as global investors from Japan for over a decade now. On this channel, we have one mission, to cut through the noise and give you alpha in both life and markets. And so the alpha opportunity for today is China. Yes, why you need a little bit of China in your portfolio. Well, the first reason why you need some Chinese equities exposure is simply for diversification. Well, nowadays we are in a world which is becoming more and more multipolar, and what we can observe is kind of move away from the American market, from a lot of international investors, a lot of pension funds globally, and there is this kind of rebalancing happening, and I think that China is going to be a huge beneficiary of this rebalancing out of the US into international stocks. So this may be true as well for Japan stocks or for like Europe equities, but the main point here is that a lot of flows are going to go into China, and actually the Chinese government and Chinese officials are working very hard to try to open in a Chinese way to all these international investors. So this is, I think, a solid first reason to consider having Chinese exposure in your portfolio, because on the long term, all the institutional investors, they will have more and more exposure to China. So better for you to actually get early and get into the best position before them. I really think that if you are a global investor, you have to allocate some of your assets to China, because if you really think about it, in a multipolar world, it doesn't really make sense to have all your eggs in the same baskets, meaning like the US. Yes, the US have outperformed in the late or the last decades, I would say, but in the end, it doesn't mean that it's going to repeat. And as we can see that more and more investors are kind of diversifying away from the US and getting back into China, because China valuation is very low and a lot of people have already left from China. So now they're coming back because what they're seeing is that, yeah, the economy in China has been very weak lately, but there's some kind of stimulus from the government first, and second, the economy is recovering definitely. For investors evaluating international markets, a key driver to consider about China is its domestic consumption story. The foundation of this is the significant expansion of the country's middle class. This demographic is not just growing, but it's maturing. Projection indicates that a substantial portion of the population will enter middle to upper brackets by 2030. So this growth translates directly into increased and more sophisticated consumer spending. As household income rise, this purchasing power boosts corporate revenues definitely. So we see this trend benefiting companies across various sectors, particularly in consumer durables, electric vehicles, and domestic brands that align with consumer preferences. So for an investment portfolio, this ongoing shift from a production to a consumption-led economy presents really a long-term growth thesis. So the core reason to invest is to gain exposure to this expanding internal market in China and the companies that serve it. So for example, Alibaba, but also like BYD or all the EV companies. So the third reason why you need Chinese exposure is mainly because actually China is a leader in many industries and is becoming very innovative actually. I think that a lot of people still have an image of China as the manufacturer of the world and kind of a low quality producer. But what we have seen like in the recent years is that Chinese, they have like focused on some very specific industries like the EV industry, the solar industry, the AI, the robotics. And what we can see is that they are dominating all these industries. And this trend is going to continue more and more because Chinese government has pledged like to become a real superpower, and especially in AI and robotics. I think this is going to change the world, but this is also going to change the Chinese society. And so what we can forecast and foresee from here is that China is going to continue to become more and more innovative, and is going to become a dominant force in terms of AI and in terms of all the new technologies that we are seeing today related to robotics, to basically solar, EVs, AI. And if you want to actually take the wave and really benefit from these huge tailwinds, I think that investing in some Chinese equities, especially the tech equities in China, is going to be very beneficial for your portfolio as well. So the fourth reason is mainly fiscal and monetary stimulus, especially in strategic industries who are going to benefit from the government backing in China. So aggressive fiscal and monetary stimulus could be a huge catalyst for both consumption and the stock market in China. And that's why you should not ignore that part. So first of all, in terms of monetary stimulus, this is what we've seen in last September and what we've seen as well so in March. So the People's Bank of China, or what we call the PBOC, is actively making money cheaper and more accessible for a lot of participants in the market in China. So they've been cutting interest rates, particularly for crucial sectors and small businesses, making borrowing more affordable. And they've also reduced what we call the reserve requirements ratio for banks, which means that basically banks have more money to lend out. So all of this is basically injecting more liquidity into the system and reducing financing costs and encouraging both consumer spendings and business expansion. So the goal here is basically simple: make it easier for money to flow into the economy and let the economy grow. So what does it mean for consumption in the stock market? So it's basically a powerful combination. So when the government spends big and makes borrowing cheaper, it directly fuels consumer confidence and increases purchasing power. So we're already seeing positive signs in terms of domestic tourism in retail. So we haven't seen actually the benefit of those monetary policies in all industries, but at least in these ones, we have seen very positive developments. And so this uptick in terms of spending, coupled with easy credit and strong policy support, creates a very fertile environment for business to thrive. So for investors, this points to significant opportunities in the Chinese stock market. And the second point is actually fiscal stimulus. So what's the difference? So monetary stimulus is basically coming from the central bank, and the fiscal stimulus is coming from the government, or in China, local governments and central governments. So Beijing is basically pouring a lot of money into the economy, especially to incentivize people to consume more and more. And so you have to think about it as like coupons and reduction for a lot of businesses and consumers. So all of this is basically tax cuts, as I mentioned, coupons, fee reductions, and this really encourage both two things, so investments and consumptions. Okay, so reason number 5, and the reason number 5 is about China's AI dominance. So as of today, actually, China is actually trailing the US in terms of AI capabilities, especially because their growth has been curtailed by the export controls made by the US, especially in terms of NVIDIA chips. But what we've seen actually lately is that China has been catching up in terms of AI. But just to rewind a little bit the script, so actually China was a leader in AI before the ChatGPT moment of OpenAI. And what we've seen with NVIDIA and OpenAI is that the US have actually took the leadership position in terms of AI, and China actually ended up like lagging. And it has been very hard for them to actually catch up because they were constrained in terms of chips needed to actually build these large language models. But what we've seen like in the recent years, or I would say in the recent months, is that China has actually been able to catch up and actually go to the level of the US in many areas of AI. And today, like what we are going to see is that China is going to become more and more dominant in all the different aspects of AI. And what I mean by aspects of AI, so we have first in terms of models, so the development of large language models, either like core models or even like smaller models. And this was basically what was the DeepSeek moment about, is that the fact that China has been able to demonstrate to the whole world that they were able to develop models much more efficiently even though there's a lot of controversy about that. But the fact that DeepSeek actually have been able to deliver a model which was on par with US models was a huge achievement. And so we have as well, in terms of chips, so we've seen that, for example, Huawei has been able to develop chips which are actually coming pretty close to NVIDIA chips, and this is going to be a huge, I would say, boost for the AI environment in China, and especially that a lot of Chinese companies are going to move away from the NVIDIA environment and the NVIDIA ecosystem with CUDA to the environment for Huawei, and Huawei with their Ascend chips are going to become a leader and a huge driving force for the whole AI ecosystem in China. And finally, so we've talked a lot about what we can call like software AI, but we have a lot about physical AI, meaning robotics. So China has been a leader in terms of robotics. In the past years, we've seen that in drones, we've seen that in terms of EVs, we've seen that in terms of robotics, and this is going to continue to accelerate. Why? Because China is the main, I would say, manufacturer of the world. They are the best in terms of manufacturing either robots, either cars, or any type of hardware. And when you're going to mix this hardware with the AI models, what we can see is that in China we will see the growth of an AI-driven economy, and we will see a lot of efficiency coming out of China. So just to wrap up this point, so China is going to become a dominant force in terms of AI, not only in China, but also in Southeast Asia and in other markets where China has a lot of influence. So reason number 6, why you need Chinese exposure in your portfolio. So basically, nowadays what we can observe in the market is de-dollarization of the world, meaning that less and less country rely on the dollar, and the dollar is quickly losing its reserve currency status. So in this kind of world, which is becoming more and more multipolar, it's very important for global investors like us to have exposure in very strong currencies. US dollar is one of them, but it's not the only one, and it's very hard to say like how the status of the dollar is going to evolve. And so one reason to have Chinese exposure is to have exposure to the renminbi. So China is the second economy in the world, and basically the Chinese currency is going to become a strong currency given all the gold reserves that China has and the economy that they will have in the next 5 or 10 years. And so having exposure to this currency, the renminbi, is a very important defensive play for any investors. Well, so that was 6 essential reasons why you need Chinese equities in your portfolio. So as we've seen, there is a lot of potential for Chinese equities. And so if you're also interested in other Asia, US and Japan market news and analysis, so feel free to check my other videos and to stay on the channel. And if you like it, just push the like button, put a comment and subscribe, and see you in another video. Bye.